Hi there! If you work in finance or want to start working in this segment, you must understand financial functions. In this video, I'll show the top 5 Excel financial functions which will make your life a lot easier. And I'll also explain the key financial concepts behind them. Are you ready? So let's start! The first calculation you need to understand is the future value, which is used for investment planning. For example, if you invest £10,000 today, the future value of this investment after 1 year, assuming a 10% per annum return, will be equal to £10,000 times the interest factor, which in this case is 1 plus 10%, to the power of 1, as there is only 1 year required in this example. In this case, your investment will be worth £11,000 a year from now. However, instead of remembering this formula, simply use the function future value, which does all that work for you. This function has 5 arguments. Rate is the compounding interest of your investment. NPR is the number of periods your money is being invested, like 1, 2, or more years. Now, an important tip here. If you are using a rate, which is a percentage per annum, the unit to use for NPR must be in years. If your rate is given as a percentage per month, then the given period must be converted in months. Make sure you have this equivalence in place, otherwise your results might get distorted. We also have here the argument PMT, which is any intermediary payment that took place during this period. In this case, it's assumed as 0 in this example. We then have the argument PV, which stands for present value, which is simply the amount invested at today's date. And finally, we have the argument type, which reflects the type of amortization. This can be either 0 for amortization taking place at the end of a period, which is usually the case, or 1 if you want the amortization at the beginning of a period. By default, Excel chooses 0 for you, so it's not a big deal if you forget about this argument. If you close off brackets and press enter, you can see Excel returns the correct value of £11,000. However, you can see it's being displayed as a negative number, and there is a good explanation for that. Excel is a very precise software, and while working with financial functions, it considers a typical money flow, which can be represented by a diagram like this. So if you are investing your money, the variable present value should be represented by a negative value, as this is basically money leaving your bank account. When you recover that money plus any accrued interest after a certain period of time, you then basically have a future value, which must be positive, as this is basically money coming into your bank account. And the way Excel accounts for this flow of money is by working with opposite signs for present value and future value. In this case, as we didn't use a negative sign for this present value, Excel returns now a negative sign for the future value. This could be seen more like a bank loan, where you first receive the money, which is a positive present value, and then later you repay the money, which is a negative future value. Keep this concept in mind while working with financial functions. However, if you are just interested in the absolute value of your functions, simply insert a minus sign at the beginning of your function to get a positive value here. If you understood the concept of future value we just explained, you can now quickly understand what present value means, as this basically works the other way around. In this case, the question here is, what's today's value of an investment worth £11,000 1 year from now, assuming you are making a 10% per annum interest in that investment? In math terms, you simply need to divide £11,000 by the interest factor of 1 plus 10% to the power of 1, which gives you the initial £10,000 we mentioned before. The interest rate in this case is also known as discount rate, as the present value calculation discounts the higher future value to a lower amount of present value, which reflects the interest earned during this period. But of course, let's save time by simply using the function present value, which has pretty much the same type of arguments as the function future value. And here, let's assume there is no intermediary payments in this flow of money, and that the amortization takes place at the end of the period. So these two arguments need to be zero. And as you are interested in the absolute result only, don't forget to use a negative sign at the beginning of this function, and your result should look like this. Now you might be wondering about an example which includes intermediary payments. The best example is your home mortgage. In a typical mortgage, you sign off a mortgage agreement, which indicates a contractual interest rate, the amount of debt the bank is financing, which is expected to be fully repaid, at the end of the agreed contract duration. Once you have these variables, you can then quickly calculate the payment that is taken out of your bank account every month, which is represented by this diagram. And once again, let's use the respective Excel function to perform this calculation, which has similar arguments to the ones used in the functions present value and future value. And let's make sure we have end of period amortization for this last argument and a negative sign at the beginning of this function, as we are interested in the absolute figure only. This function generates a value of just over £33,000 per year. In simple terms, Excel basically indicates that if you take a mortgage of £300,000, which requires you to have an interest rate of 2% per annum, you will fully repay that loan after 10 annual payments of around £33,000 per year. Let's assume now you're about to purchase a warehouse which you will refurb and rent out for 5 years. How much value will that investment add to you based solely on this information? This can be answered with the net present value assessment. Net present value is basically the sum of the investment to be made at today's date and the present value of a stream of cash flows, such as the net rental income of our warehouse example. Now note that if we are talking about present value, we need a discount rate. This discount rate is basically the minimal required rate of return which you can get in any alternative investment of the same risk. Excel has two functions that perform the net present value assessment. The most basic one is the NPV, which is used for payments taking place at regular intervals, like every 30 days or every 365 days. As this is rarely the case, there is another function called XNPV, which considers the actual dates when you expect the stream of cash flows to take place. Therefore, the arguments of that function are the rate, which is our discount rate in this example, the values, which is a stream of cash flows, and the dates when those cash flows will take place. In this case, the NPV is positive, so it makes sense from a financial point of view to go ahead with this investment. As the sum of the present value of the future cash flow is greater than the investment itself, the result is a positive number, meaning that such an investment adds value to you or your business. The last financial concept to understand is the internal rate of return, which is widely used by investors globally. This is the rate of return that brings the net present value formula we discussed previously to zero. By using the same approach to a series of investments, you can then quickly compare which investment has the higher rate of return, where the higher the better. This return is also usually compared to your required return. For example, if you have an investment opportunity which gives you a guaranteed IRR of 6%, but you already have your money invested at 8.5% per annum, which is your required return, then it does not make sense to switch investments. However, should the IRR of the alternative investment be 12%, then it would make sense to switch as your required return is now lower than the IRR of the new investment. And just like the NPV, there are two functions in Excel to make this assessment: IRR for regular intervals and XIRR, which assumes actual dates when the stream of cash flows take place. The arguments of the XIRR function are values, which is the stream of cash flows of an investment you might take, the dates when you expect the stream of cash flows to take place, and the argument guess, which is optional. The XIRR function performs an interactive calculation to solve for the rate of return. By default, it starts at a rate of 10% and then goes up and down until the NPV of the underlying cash flow becomes 0. As this is an optional argument, if you omit it, Excel assumes 0.1 by default. And again, using the same numerical example as the NPV, we can get an IRR of 23.7%, which is way above the required rate of return of 8.5%. Therefore, as this investment adds a lot of value, you should go ahead with it from a financial perspective. Now it's time for you to practice what you just saw in this video. Remember, you can download for free the spreadsheet used to produce this tutorial, which is in my blog. The link is on the description. I wish you all the best. Don't forget to subscribe to the channel and see you in our next video.